Once upon a time, what Wall Street now celebrates as shareholder value was considered something else entirely. Fraud. If a company used its own cash to inflate its stock price, it wasn't hailed as smart management. It was market manipulation, the kind that could get executives arrested, companies shut down, and fortunes wiped out. Today, somehow, that same behavior is praised as financial genius. Stock buybacks, companies repurchasing their own shares to boost prices, have become the quiet heartbeat of corporate America. They lift markets, enrich executives, and transfer trillions of dollars to investors without creating a single new idea, product, or job. So how did a tactic once treated as a crime become the foundation of modern capitalism? Welcome to the Financial Historian, where money, power, and history collide, and the truth is always hidden in plain sight. The story of stock buybacks starts with a crash, the crash that almost ended capitalism itself. In the 1920s, Wall Street was a stage show. Executives traded their own company shares behind the scenes. Insiders pumped prices, dumped stocks, and pocketed fortunes. The market wasn't a marketplace, it was a magic trick. And when the trick failed in 1929, the consequences were brutal. Companies had been using their own cash to prop up their stock prices. They made their businesses look healthy, stable, growing. But when panic spread, those same companies were forced to sell shares to survive, accelerating the collapse and dragging millions down with them. By 1933, faith in the system had evaporated. Banks closed. Lines for food stretched around blocks. 1 in 4 adults was out of work. TDO for free market became a joke or an insult. So the government stepped in. The Securities Exchange Act of 1934 rewrote the rules. It created the SEC and sent a clear message. Companies manipulating their own stock prices will not be tolerated. Buybacks weren't a bon biname, but everyone understood the message. If a company repurchased shares to influence the price, it could be charged with illegal manipulation. So for 50 years, buybacks practically disappeared. And during those 50 years, America built the world's strongest economy. Companies reinvested profits. Factories expanded. Wages rose. Innovation exploded. CEOs weren't paid to manage stock prices. They were paid to build things. Then, in the 1970s, something changed. Not in Washington or on Wall Street, but in the classrooms of elite universities. Economists like Milton Friedman began promoting a radical idea. The only responsibility of a company is to increase shareholder value. It was a simple idea. A clean idea, and a dangerously incomplete idea. Because once CEOs accepted that their job was to maximize the stock price, not to serve workers, customers, or society, the entire economy shifted. Companies no longer wanted growth. They wanted higher charts. But they needed a way to get those charts without investing in the messy, expensive real world. They needed a shortcut. That shortcut arrived quietly in 1982. While most people were focused on inflation, Cold War politics, and the recession, as long as they followed some loose daily limits, they could buy back their own shares without being accused of manipulation. No hearings, no debate, no media coverage. One of the most powerful changes in modern economic history was introduced almost invisibly, and with that what had been a crime for 50 years became legal, even encouraged. Corporations suddenly had a magic lever they could pull to make their stock rise on command, and they pulled it. At first, buybacks were small, a few $100 million, then a few billion. But soon, corporate America got hooked. By the 1990s, buybacks topped $100 billion a year. By the 2000s, they became the primary way companies returned value. By the 2010s, annual buybacks exceeded $1 trillion. The math behind them was simple and devastating. When companies buy back shares, the number of shares shrinks. Fewer shares means higher earnings per share. Higher earnings per share means higher stock prices. Higher stock prices mean CEOs hit their bonus targets. Nothing about the business improves. Just the numbers. This isn't capitalism. It's algebra disguised as profit. The 1990s turned buybacks into a corporate art form. Tech companies used them to offset stocks option dilution. effectively using shareholder money to boost executive pay. Then came the 2008 financial crisis. Taxpayers bailed out the banks, and once the crisis passed, those same banks spent the next decade buying back their own stock, using profits, and in many cases, borrowed money. Between 2009 and 2019, the S&P 500 spent over $6 trillion on buybacks, more than they spent on all new investment combined. Buybacks didn't make companies stronger. They made them fragile. Beautifully, dangerously fragile. And yet Wall Street celebrated them as efficient. In a system worshipping the stock price, illusions always beat reality. By the late 2010s, buybacks had become the main product of corporate America. Apple, Microsoft, and ExxonMobil accounted for nearly a quarter of all airlines used profits to buy their own shares, then demanded bailouts when crisis hit. Retailers slashed wages while shoveling billions into buybacks. Even companies once known for innovation turned into financial machines. The economy stopped building. It started looping money back into the markets, feeding on itself. Governments followed the illusion. Rising stock prices became proof of stability. Central banks watched charts like lifelines. Politicians bragged about the Dow as if it were GDP. As long as the market stayed high, the system looked healthy, even if the foundation was crumbling. Buybacks were supposed to signal confidence. Instead, they signaled dependence. Corporate debt doubled. Investments stagnated. Wages fell behind inflation. Wealth concentrated at the top 10%. The people who owned most of the stock market captured almost all the benefits. Everyone else got the bill. When the pandemic hit, the illusion was exposed. Companies that had spent a decade inflating their stocks suddenly had no cash. They lined up for bailouts. The same public who paid for their failure watched CEOs walk away with bonuses funded by buybacks from the good years. It was the perfect symbol of the modern economy. Incredible efficiency at transferring wealth upward. Disaster at preparing for crises. Buybacks weren't a tool anymore. They were a philosophy, an ideology that prizes appearance over durability, charts over reality. And here is the final twist. What was once banned for destroying markets is now used to prop them up. Governments rely on high stock prices for confidence. Pensions depend on inflated valuations. Central banks use them as indicators of economic stability. Manipulation didn't disappear. It became policy. The result isn't capitalism. It's choreography, a performance designed to make decline look like growth. Because the real danger isn't the next crash. It's the moment people realize the prosperity they believed in was built on buybacks, not productivity. When that belief breaks, the illusion breaks with it. Buybacks were legalized to make markets efficient. But efficiency without purpose isn't progress. It's decay accelerated. If this opened your eyes, hit subscribe. History doesn't repeat, but it rhymes. And I'll show you the verse everyone else ignores.